All right, everybody. Well, welcome to banking and money management. The focus of this kind of module is really just to see how we should be utilizing our banking and financial institutions, what type of banking and financial institutions are out there, and then ultimately, what can we do to utilize these to the best of our abilities? Okay. So some of this is probably going to be fairly elementary. Um, Feel free to skip and browse through this video. Of course, you'll have the PDF uploaded in our course. But I just wanted to make sure that we're kind of all on the same page. So some of you may be coming to this class with already a certain level of financial acumen, and others may be completely kind of in the dark. So kind of want to make sure that we set kind of an even playing field. Okay, so let's go ahead and get started. So money management is just really the tools that we use that help our cash inflow and our cash outflow. We mentioned in one of our previous modules about this idea of liquidity. It's the idea that we need to have cash or cash equivalents in order to be able to pay our bills, or to pay any other expenses, right? So we need to be able to have that money available to use. And so there's a lot of different ways that we can store that money and have it in a way that we then can ultimately use it, right? It could be in our checking account. We could theoretically use it in cash. We could have money in our home or in our apartment. However, you may have actually gone to places and try to buy something, and you might see a sign that says um, credit cards only, or we don't have cash, right? So we need to be extremely careful with, as we move into making purchases, that we just can't carry a bunch of cash around, especially if you're going to buy something that is fairly expensive. You don't want to be walking around with, a couple $1,000s in your pocket. So we want to make sure we understand how we can use various tools to engage in all of our transactions. Okay, so let's just talk a little bit about one of the things that we want to make sure we have when it comes to our liquidity. We want to make sure we have enough cash or cash equivalents to be able to pay for something that is unknown to us. Okay, and that's really important. We want to make sure that these are unknown to us. If we know that we're going to have a trip coming up in a couple of months, or if we know we're going to need to replace our freezer or our AC unit, that's not really an emergency. That is something that is known that is going to be coming up. An emergency would be driving down the highway and your car breaks down. If you knew that your car was going to break down, you would have probably taken a preventative measure so that you didn't have that problem. Nobody enjoys being stuck on the side of the road. That would be an emergency. You might have to pay for a mechanic to fix your car. And in some cases, you may actually have to get a different car, right? There may be a significant problem. You don't know that perhaps you're just going along and your AC goes out. You don't know that that's going to happen. If you did, you probably would take preventative action. Okay, so we want to make sure that when we're dealing with our money and our ability to have liquidity, yes, we need to make sure we have money to cover our known ongoing expenses, our rents, our insurance bills, our food, our groceries, all of those things. But we need to make sure we have enough money to be able to cover the things that we don't know that are going to occur. Okay. All right. So what is an emergency fund? It's basically money that is set aside to be used in the case of an emergency. Now, here's the other thing that we need to be very careful of. As I've counseled individuals and couples over the years, many a times they will set aside money for an emergency fund. And I'm going to put this kind of in parentheses. The challenge with this concept for many people, especially if you are in a relationship, is what is an emergency? For everybody, that may be different. Okay. For someone, not having a dress to go to a formal is an emergency. For someone else, needing a client dinner that was unexpected that you feel like you have to pay for, that might be an emergency. Uh, but for other people, they may say that's not an emergency. So that really is not what that money should be used for. So what is very important here is that you define what an emergency is. And I would encourage you, especially if you're in a relationship, and if you're not, someone that maybe you have holding you accountable to your finances and to make sure that you're not just frivolously spending money all the time. If you have an accountability partner or if you have a spouse or a significant other, I would encourage you guys to define what an emergency is. An unknown car breakdown or mechanical issue with one of your major appliances, um, a loss of a job to be able to cover monthly non-discretionary expenses, things like your food and your rent. Okay, these would be listed out. And so you have these, and as long as you agree on these, you would put these aside and say, okay, we will only use money from this account at our bank if one of these three things occurs. Our AC unit breaks down, our car breaks down, or we lose a job and we need that money to pay our bills. Okay. So, but again, if you don't define what an emergency is, then anything could be classified as an emergency. And therefore, you're just using this money for whatever you would like, which you might as well move it over to your regular checking account. Okay. So, again, it's designed to be for specific purposes. I've already touched on this a little bit. Obviously, why do we need this? Unexpected expenses, right? This is the one that really is what we're looking for. Unexpected, unknown. Okay. The other thing that it does, and this is kind of a characteristic that is very helpful, is it avoids the fact that if we don't have money aside for an unexpected expense, the only other way we're going to be able to cover that, if we don't have money aside, is through taking on debt, having to put that on a credit card, or to borrow money from somebody. We don't really want to have to do that. Okay. And then finally, as you see on the screen, it helps to alleviate this feeling of, oh my gosh, what if something happens? It is not a tangible benefit, right? We can't actually put a dollar and cent value on this idea of peace of mind. But for those that are in a relationship, if there are two people and one of the individuals in a relationship is nervous about their financial situation or extremely concerned that maybe there's not enough money set aside for if there is an emergency, having money set aside can truly begin to ease people's anxiety and fear about something happening. Okay. And that can create a significant better relationship, knowing that both individuals are okay, right? Are feeling good about where they are in terms of financial um, position. Okay, benefits of an emergency fund. Obviously, it's there to preserve your assets should something happen. It's also there to help, again, avoid the use of debt. It provides peace of mind, and it actually would help eliminate unnecessary expenses, right? So if you have money set aside in your retirement account, for example, and you need to get a new car, and let's say you're mid 30s and you take money out of your retirement account, you're going to get hit with a penalty because you've taken that money out prior to the age of 59 and a half. And so you don't want to have to not only reduce your retirement funds, because remember that money is for a specific purpose, retirement, but also you're going to be hit with a 10% penalty. On top of that, you're going to be taxed on that amount. So what you take out in order to pay for this car example, you might have to take out more money to pay for the taxes, and you might have to take out an additional money to pay for um, the fee. I'm sorry, the penalty. So you're taking out the money for the car, the money for the penalty, and the money for the taxes. So you're taking out an even larger chunk of money. So again, we don't want to have to do that. So this emergency fund really is helping to eliminate some of these types of transactions that would be required if you didn't already have money set aside. All right, so how much do we need to save? Now, this is a question that you probably will hear a lot of people ask, and there's going to be a very traditional answer. And the answer is 3 to 6 months of non discretionary expenses. 3 to 6 months of non-discretionary expenses. Now, there's a huge caveat to that, and that is one, we need to make sure you understand what non-discretionary expenses are. Those are expenses that you kind of have to pay, right? Your rent, your utility bills, your food, gas in your car. Discretionary expenses would be things like entertainment, subscriptions, like non-required subscriptions, those types of things. Now, 3 to 6 months, again, that is a traditional textbook answer. However, there are some people who do not feel confident that 3 to 6 months is enough saved to make them have that peace of mind. So I encourage you to determine that amount based on how comfortable you are with your financial situation. Let's suppose that you have a very large income and only one of a couple works, where you don't have two streams of income. You may want to have more money set aside should that one breadwinner lose their job or not be able to work in that same job moving forward. That may require, you may feel like, wow, the job could be risky, so let's have more money set aside. Let's suppose that you have two working people in a relationship and both have very, we'll call them secure jobs. Well, maybe you need less money or feel like you need less money. Okay. So 3 to 6 is just a guideline. It's just a rule of thumb, but there may be individuals who have more than that. And in fact, I worked with a client. They actually had almost 2 years of non-discretionary expenses set aside. That was a lot of money. And I had conversations with them because they could have used more of that money in higher yielding or higher earning investment options, but they really didn't feel comfortable having that money not be available to them should they need it very quickly. So again, keep that in mind. Also, it's going to depend on how much money you make and what your expenses are. Again, if you have one solo breadwinner and they make a lot of money, you may and you have higher expenses because the income have matched your expenses as you maybe get more and more higher salaried positions. You may want to have more set aside because, again, if something happens, you have a lot of maybe now non-discretionary expenses. Your house mortgage payment may be a lot higher than it would have been otherwise. So you need to keep in mind your income and considerations. And then again, other factors, again, is just making sure we have this idea of peace of mind. Okay. Okay. So let's just talk a little bit about financial institutions. I hope that all of you are somewhat familiar with the types of depository institutions we're going to talk about, specifically our banks and what used to be savings and loans. And of course, there are banks of all different sizes. You can have community banks where there's just one or two branches and they really serve a community. You can have a regional bank that maybe is around maybe 2 or 3 different states. Or you could have very large national banks like Wells Fargo, Bank of America, that are already pretty much in almost every state. Okay. These banks are typically called commercial banks. Okay. And they do two things. One, they are bringing in deposits. Okay. So they accept deposits in the for being able to provide loans. And we'll talk a little bit more about that momentarily. All right, so why are banks so important? Well, let's suppose that you have money in your fire safe in your house, and your house gets broken into, and that fire safe gets stolen. You don't have any coverage. You don't have any recourse to be able to get that money back. However, when the money is in a bank, when it is in a financial institution that is covered by the Federal Depository Insurance Corporation, FDIC, you actually have basically an insurance policy. So if that institution, that bank was to go under, right, was to become bankrupt, you would actually have this insurance policy that the FDIC would pay you up to a specific amount of money per types of accounts that you have. Okay. There's going to be a couple of examples that are coming up. We won't go into great detail. I want you to be able to look at those on your own. Of course, send me emails if you have any questions, but it'll look at an individual who has multiple different types of accounts and how much FDIC insurance coverage they have. Okay, so what are some of the different types of accounts that you might have at a financial institution? They're listed here. A single account would just be an individual, one person who is solely responsible for that account. We could also have a joint account, and a joint account is two or more. Don't think that that is just two people. Joint really is just two or more. You can have 4 or 5 people on a joint account, and that is completely fine. Not really common, but typically you have two people and sometimes maybe 3 people. But most of the time you don't have more than that. You could have a business account, right? So this is where the business owns the account that then has an authorized individual to act or transact on that account. And then you could have a trust or an estate account. So individuals will create trusts that those assets are then placed in the title of the trust. And then you have a trustee that is going to be acting and managing the account. Kind of the same thing with an estate. When someone passes away, a lot of assets then are transferred to an estate account at a bank. And then the executor or the administrator of that estate will then act as the one who's able to transact on that account. Okay, we're going to talk a little bit again about FDIC insurance. This really is, oh, this is kind of a duplication. When you have FDIC insurance, there is a maximum of $250 per depositor per the type of account and also per beneficiary. Okay, so that's important because as you have more beneficiaries on your account, the more FDIC insurance you are actually eligible to receive. Okay, so as you go through this module's content, there's that the reading and there's a couple of other items. I would encourage you to go to the FDIC website, and it actually has various calculators. And you could say, I want to look at, say, me and another, my significant other, and let's say we have 3 beneficiaries. These are the types of accounts that we have, and it'll actually give you how much FDIC insurance coverage you would have. Okay. And so here's an example, and actually then I think the next slide or two actually will give you the answer, but I'm just going to let you take a look at it. We're looking at Andrea. There is multiple accounts here, and as you can see, there's some joint accounts with Andrea and Brandon, and then there's also an Andrea, Brandon, and Sierra, and then there's also a joint account with Kirby. Okay, so there's various accounts here. So I'm going to give you an opportunity to go through and look at this, and you will see that they actually have an overage of coverage, meaning that they have more money in the bank than the FDIC would allow. Okay, and again, you'll see that on your screen. Here's just another example. I think they're looking at Brandon in this case. The first example was Andrea, so you can take a look at that. And again, I really want you to be able to see that on your own. If you have questions, feel free to email me as we go through the class. All right. Outside of banks, are there some other financial institutions that we might be able to look at? And yes, we actually have savings accounts or savings institutions. We have credit unions. Savings institutions are not as prevalent as they used to be. So back in the mid 80s to late 80s, savings institutions were much more robust, right? We used to call those savings and loans, but they actually really, a lot of them, there was a big bust in the late 1980s, and a lot of savings and institutions or savings and loans actually went bankrupt. Okay, so we don't see a ton of those anymore. There may be a few out there. We do see credit unions. So credit unions are typically attached to serve some form of association or members. In many of your communities that you may have come from, you might have seen like a teacher's credit union. If there was a large employer, there may be that employer may have had a credit union established to serve their employees. And then typically you have to have some affiliation with that organization in order to become a member. And in many cases, once you become a member, you can also pass that membership down to your family and they can maintain the membership. Now, there are some advantages to credit unions in that they actually have a tax preferred status. So they're able to actually charge sometimes a little bit less in their loans and actually pay a little bit more on their deposits because they don't actually have taxes, right? So they're kind of a tax exempt status. Okay, so all of these kind of banking institutions, right? So whether it's banking or credit unions, what do they offer? Well, we know that we can typically get checking services from a bank. We can go and open a checking account. And what does that provide you? It provides you the ability to write checks or to transact on that account through checks. Okay, and if you've ever seen a check, right, it's that piece of paper that has the page of the order of and a long line, etc. The other thing is a lot of times they allow you to have cards, right? So debit cards that are attached to these accounts. So a debit card is a little bit different than a credit card. A debit card does not provide you any credit. It actually links exactly to your checking account. So if you have $1,000 in your checking account, the debit card will allow you to pull out that money at a merchant and use that card up to $1,000 or whatever your balance is. They also have savings accounts. Savings accounts again are accounts. Now they do have typically higher interest capacity, but they have limitations. In other words, you are limited to the number of transactions that you have, um, and and that's designed to again to keep the money in the account. And obviously, banks now can use that as part of their lending capacity. There's also money market accounts. So this differentiates from a savings account because the bank is actually using money market instruments, which are going to pay a little bit higher interest rates than a savings account. Now, typically we have uh, minimum balances. So if you ever go to a bank and you say, "Hey, can I get a list of your interest rates?" They will probably print out, or maybe you can go on their website, some sheet, and you might actually see a money market account interest rate, which is going to be higher than their savings account. But one of the things that you might see is that you have to have a minimum balance of, let's say, $25,000 minimum or $100,000. And with those higher balances, you actually are going to be able to earn higher interest rates. The other thing that banks offer in many cases are safety deposit boxes. That's where you can go into a bank, typically go into some form of a vault, and they will rent you out a box that is going to be secured by that vault, in which you have a key and the banking institution has a key, and the valuables then are placed in this extremely protected place, right? So it's a safety deposit box. Coupled with debit cards are also ATM cards. ATM cards were far more prevalent before really the surge of electronic banking. You would be able to go to an ATM machine, use your ATM card, and pull out cash from that machine. You weren't able to use that at a merchant like a grocery store or Walmart or something like that, but you could go to the ATM machine. Well, now debit cards kind of act in that same way. You can take your debit card to the ATM machine and use it as an ATM sub card. But before that, they actually would give you just an ATM card that was only able to be used at an ATM. Okay, so checking account. What are some of the advantages of having a checking account? Obviously, it gives you immediate access to your funds. It is very liquid. You don't have to have cash sitting in your mattress or in a safe or in a fireproof safe at your house. Very convenient for being able to pay bills. Okay. Some of the disadvantages, as you might see, is you don't typically earn any interest on that money, which would make sense, right? The money could go in one day and out the next day. It would be extremely challenging for banks to determine what the types of interest crediting mechanism you would have for these funds. So you get liquidity, but with liquidity, you lose the ability for interest. Now, savings accounts, obviously, they are also liquid. Now, they typically have maximum, I should say, maximum withdrawals per month. So if you have a savings account, you might find that the bank says you can only get 6 withdrawals per month before you are starting to assess a fee. Okay, let's look at the advantage of the bank. So liquidity, you can go into the bank and pull that money out. Just keep in mind there are limits to the number of transactions that you have. You still can use more than 6. Obviously, there will be a fee with that. Or if you need to take all of the money out within the 6, there wouldn't be a fee for that as well. They are federally insured, and it will earn a higher interest, right? So because you are locking it up, you are putting it aside for a longer period of time, the bank is going to give you a higher rate of interest. Okay. Disadvantages is in some cases they are going to have minimum holdings, like maybe you have to put it in there for at least 30 days. I don't see this a ton with savings accounts. What really is the big disadvantage here is you only get 6 transactions a month, typically free of charge. Um, Here's a video that you can go to. I think it's going to be linked in the PDF, so you should just be able to click on it. And it's just going to talk a little bit about banking and money and investment. So again, I would encourage you to take a few moments to look at that. All right. As I mentioned earlier, there are these money market deposits. Now they're using, instead of the bank paying you a savings rate, they're actually using things like certificates of deposit that are brokered. They're using commercial paper. They're using T-bills, and many of those products are going to be very liquid because they're going to be maturing in the next 30 days. Okay, so there's a very high liquid position, very and a lot of maturity, but they are going to earn a higher rate of interest. However, in order to be able to put those products together, they do require a minimum balance in most cases. Okay, so this is just an alternative to the savings rate. And in many cases, they will actually give you the ability to write checks or have a debit card on that account. Okay. Again, as I mentioned, there are typically higher balances, and if the balances drop below, there will be typically penalties, or they may require you to close out your account. Okay, now how does that really differ from mutual funds? Now, mutual funds typically are not bank driven. Okay, once you have mutual funds, we are typically moving into investments, not banks. Okay, banks have money market accounts, and yet investment vehicles typically will have money market mutual funds. Okay, so it's typically a pooled product. Typically, you have to be licensed to be able to sell that. Now, again, what are some of the the advantages? Higher interest rates. It's obviously convenient, but sometimes, again, I don't see a ton of banks offering these mutual funds because they're typically classified in the investment world rather than the banking world. And the investment world is not under FDIC insurance. So we just got to make sure we differentiate those. So there is going to be some nuanced here. If you happen to go to a bank, you might ask them, do you have mutual, money market mutual funds? And they will just say, well, we do have money market accounts, but we don't have money market mutual funds. So again, just keep in mind that the vernacular here of mutual funds may create some challenges. Okay, another product offered within the banking institution are certificates of deposits, also known as CDs. So when you hear of a CD, it's typically referring to this idea of a certificate of deposit. And a certificate of deposit basically is I'm going to the bank, I'm going to deposit some amount of money for a specified period of time. So we have a specified period of time, typically as low as 7 days, all the way up to 6 or 7 years. Okay. And as you put money in the CD, you are basically locking it up, and the bank now can use that to loan it out. Okay. It is going to pay typically a fixed interest rate. It's very convenient for an individual or joint holders who, let's say, want to have money available at a specific point in time. Let me give you an example. Let's suppose that you want to go on vacation in 3 years, and let's say you inherited some money, right? So let's say you had $5,000 and you want to use that $5,000 to go on vacation, but you're not going to go on until 3 years when your oldest child graduates college, for example. All right. So what you would do is you would go to the bank, you would take your $5,000 and you would put it in a 3-year CD or certificate of deposit. And it locks that $5,000 up at whatever interest rate the bank is paying at that time for a 3-year CD. And in 3 years, you are now going to receive the money. Okay. But it's nice because it has kind of it's kind of put a lock on that. So you can't just decide, hey, I just want to go spend this money. Okay. Now, you can access it, but it will require you to pay a withdrawal penalty. And that typically is not ideal. Okay. So if you feel like that money is not going to need to be used, or I'm sorry, if you feel that money is going to be used or needed, don't lock it up into a CD. Put it only into your savings account. Okay. Now, CDs are going to pay a higher rate of interest than the savings account. So depending on Again, how comfortable you are locking that up for 3 years, that would be the way to go. And there are some people that will actually take the approach of determining a ladder of CDs, right? So maybe they don't want to take that $5,000 and just dump it into a 3-year CD. Well, maybe what they want to do is they want to put 1,000, 1,000, 1,000, 1,000, and 1,000. And this is a 6-month CD. This is a 12-month. This is an 18-month. This is a 24-month. And this is a 30-month CD. Okay. So we know that we're only going to need another 6 months. So in 6 months, when this $1,000 CD matures, you will then move it over down here, and it will be in for and mature in this would be 6 months, so 30-month CD. And this is the date that you would want all of your CDs to mature. Okay. And then what that does is every 6 months, you have $1,000 come due, and you could say, "Do I need it? Nope, I don't need it. So I'm going to put it back into a CD that will then mature on the date that I'm ultimately wanting to use this money for the vacation." So I can build a ladder. Okay, so again, your ladder looks like this. This one is due in 6 months. This one is due in 12 months. This one is due in 18 months, and this is kind of what it looks like. Okay. And as you go further and further out, you have higher interest rates, right? So we have a 6-month at 1.25. We have a 9-month at 1.4. We have a 7-month or a 12-month at 1.75. We might have an 18-month at 1.9, a 24-month at 2.2, and a 30-month at, say, 3. Okay. So we're getting better interest rates by increasing our liquidity. I mean, our longevity. However, you might say, well, what if I just put all of it in? I'm going to get a higher interest rate. Well, yes, but you lose the ability to pull out the money when you need it without paying that interest penalty. Okay. So again, there's not a right or wrong answer. It's just a matter of how you see your financial situation. Again, just another example of that laddered CD approach. And just a couple of slides here on these. Again, I think I kind of hit all of these. Okay. So we move now into the fact that a lot of these financial institutions can offer more than just checking or savings accounts. Some can do treasury management, some can do investments, some can do loans, some can do 529 plans. There's a lot of different things that these places can do. And that's kind of this idea of this entire asset management account. Okay. So the more products and services that you use and the more money that you have with one financial institution, typically the better interest rates you get, as well as the better customer service you get. And I hope that makes sense. The more money you have, and the more services you have, the more likely that the bank is going to want to pay attention to you, right? Because you're providing them typically a higher value than someone who just has maybe one product with them. Okay. Okay. So could you go into other institutions that do not have financial coverage, right? FDIC. And yes, you can. There are institutions out there that you can transact that are not depository institutions. Think of an example. PayPal, for example, Venmo. These are transactions. You can put money into your account. They may actually pay you interest, and you can transact services, but you are not going to probably receive FDIC insurance coverage. Okay, they are typically called non-depository institutions. Finance companies, right? So lending institutions that provide loans to individuals. Those are also places that, again, are not going to have any type of FDIC insurance coverage. There are security firms and insurance companies. So security firms like Wells Fargo has a security division, but Raymond James, LPL, Merrill Lynch, which again, Merrill Lynch is now owned by Bank of America. Any of those security firms, they are not going to have FDIC coverage, but they are part of the financials world, as you might say, right? They're part of the system, the financial system. Insurance companies, State Farm, Allstate, all of those, they are also part of the financial ecosystem. Okay, and a lot of these places, let me just make sure we understand, act as intermediaries. Okay. And basically what that is that money comes in, and then it's through this intermediary that then money flows out. Okay. So think about a bank. How does money flow in? Deposits come in. How does money flow out? They are loaned out in terms of loans, and then the money comes back in terms of the payments, and this includes our interest. Okay. And then there may be some small amount paid to depositors. This would be our interest rate that is paid to our depositors, and what's left is kept by the bank. What about insurance companies? Well, premiums come in and they pay out on claims. Okay, my house caught on fire, so premiums that are coming in today are going to pay the claims of current. So money comes in and out, right? So a lot of these places are nothing more than financial intermediaries, right? They're connecting people who have extra, like for example, banks. We have the savers, people who have extra capital that are providing it to people who need capital. For insurance companies, you have people who are paying the premiums or providing it to claims who have had issues. Okay. Again, financial companies, investment companies, these are able to offer investment products, and investment products are not FDIC insurance. They actually have a different coverage called SICP, Security Investment Protection Corporation, SIPC coverage. Now, that's not for losses of their accounts. It is for their broker dealer or their institution having financial issues. Financial conglomerates, I think, Chase, Bank of America, those are probably some of the few conglomerates that provide pretty much everything. If you need loans, banking, investments, mortgage loans, anything that you need, Chase or Bank of America or JP Morgan can offer those types of services to you. Okay, so just a few other different financial products that you might need. And again, with other electronic services, these are probably less prevalent. But a cashier's check, right? You can go to your bank and say, I need a cashier's check, and they will give you a check that's basically like guaranteed that the bank has basically signed off, right? That's part of their guarantee. Typically used for larger transactions. A certified check is going to be from the customer's account, right? As you can see, that the cashier's check comes from the bank's account. The certified check comes from the customer account, and that bank certifies that the customer has the funds to cover that check. Okay. And then there's a money order. Money order is basically where you can go to a financial institution, pay them money, and they will give you an alternative to writing a personal check. A lot of people, or at least there was a period of time when people didn't accept personal checks because they don't know whether or not the money is good, right? And you got to remember, you may not remember depending on how old you are, but when you'd write a check, you take that check down to your bank. The bank then deposits it. The bank then calls the other bank, and I'm kind of making this as a kind of a linear path of how money moves. The bank calls your bank where the money is drawn off of, and then they try to get that money. Well, that may take a couple of days, and that money may not be there when the bank calls to get it, whoever deposited that check. And so a lot of people felt leery or uncomfortable about taking those types of checks, personal checks. And so a money order is basically I go to the bank has taken the money out of my account, they put it on this basically we'll call it a cashier's check, or it's a lot of it the same thing. And then you would take that and say, I have a money order for $500, and here it is. And it's typically more of a guarantee for the merchant. Okay, so banks can offer interest rates on deposits, and of course, they'll offer interest rates on loans. Okay, and as I mentioned earlier, we have this bank. I've got money coming in. If I'm the depositor, so here's the depositor. Okay, and they're going to receive a small amount. So they're going to receive little bitty money. Okay, it's very small, and then they're going to pay out to the borrower. Okay, and then the borrower is going to pay back large money. Okay, and the difference between this and this is what's kept by the bank. So the big S, which is received, minus the little s, which is paid, is the profit to the bank. Okay, so they are basically earning the spread between what they're able to loan the money out and what they are able to pay, or what they have to pay on people depositing money. And there's a lot of different aspects as to how this dynamic works. We have to make sure we understand like what the risk-free rate is, and we can use typically T-bills for that. We've got to know what our interest rate risk is, like what's the likelihood that rates are going to change. We need to make sure we understand credit risk, the borrower's ability to make this payment back to the financial institution. The more likely that won't occur, the higher the credit risk is, and therefore typically the larger that dollar sign will get. And then we have market risk. There's the ability for the market as a whole, the structure of our financial system, to not work like it should, or to start to experience maybe a recession. Because there may not be anything wrong with the borrower, but as the economy as the economy starts to move into a recession, everyone really starts to see the implications of that. Okay, I mentioned a little bit about treasury bills. So these typically can act kind of as a risk-free asset. And this is probably the closest that we would get to a risk-free asset. And why is that? Well, that's because the federal government has the ability to tax. So the US can tax its constituents, and we are one of the largest and wealthiest nations. And so the US Treasury has the ability to tax that base. And of course, that's what we use to repay our debts. Okay. So again, risk-free investment option. And it can be exempt from state and local taxes. Obviously, will depend. But again, when we're looking at this, these are very short term, right? So they go as high as 12 months in maturity. They don't go longer than that. So the shorter the maturity, the lower the interest rate. And why is that? Well, the shorter the time to maturity, the less risk there is, and the less risk, the less return. So here's just a brief example that we'll go through real quick. Let's suppose that you paid $940 to purchase a T-bill. So as you realize, this is paid on a discount. Okay, so we buy T-bills at a discount. We don't buy them with coupon payments. So we are going to buy this at $940. We're going to receive $1,000 that matures in 1 year. So we have $940 today. We're going to receive $1,000 in the future. What is the return? Well, we can do a holding period return. Holding period return would be our ending balance minus our beginning balance over our beginning balance, which is 1,000 minus 940 over 940. And that return is 6.38%. Okay, so that's how we would work that out. All right, credit risk of money market instruments. Remember, these money markets consist of things such as commercial paper. Commercial paper is, you don't necessarily need to know this per se, but commercial paper is basically a short-term unsecured loan to a very large company, right? So Boeing or IBM, McDonald's, they may issue commercial paper, and it's typically going to be for 30 or 60 days. Maybe they just need cash to pay for something, and of course, they'll get their money. So they issue commercial paper. Sometimes we have bankers' acceptances. Okay, this is basically nothing more than a line of credit guarantee. So if you're a farmer, you may go down to sell your product, and you may get a banker's acceptance, which says the bank guarantees that the money is in an account. You then now have this piece of paper which acts as an instrument. Okay, and then we have things like T-bills, etc. So all of these things act as products within the money market. All right, so this is a market that is trading money equivalents. Okay, so these are money equivalents. Now, what is the risk in there? Well, it's basically credit risk that the borrower may not actually repay on a timely basis, but it's very low because these are going to be maturing in a very short order, meaning in the next typically like 30 days or 60 days. Okay, so you just need to make sure you understand that there is going to be risk in all types of products. What about interest rate risk? Okay, well, interest rate risk really refers to this idea that we may have changes in interest rates. If you're following the financial news, you may be reading about Everyone's asking for or desiring the Federal Reserve to reduce or lower the Fed funds rate. Well, what that will do is it will make the cost of money cheaper. As the cost of money gets cheaper, companies are able to start borrowing at a more reasonable rate. People are able to buy homes at a more lower rate, and that will stimulate the economy. Okay. So the expectation of interest rate movements will actually be a risk because as rates start to fall, the value of current investments in fixed income positions will actually rise. And again, we don't need to do a lot of that here. I'm just trying to lay a little bit of framework, right? So you get that right here. As interest rates rise, the investments fall. There is an inverse relationship between what rates are going to be, what rates are doing, right? If rates are falling, then the values of current bonds are going up. Again, we don't need to get into how that works, but just for this point, just trust me. Okay, so again, money markets are short-term, typically low-risk investments that provide liquidity to various corporations. Okay, treasury bills, certificates of deposit, commercial paper are kind of the most common. Okay, so when you're looking at various interest rates, right, and various deposits and loans, we need to make sure we understand the risk. And one of the ways that risk is looked at is in terms of one's time horizon and tolerance. Okay. So, what is risk tolerance? Tolerance means to tolerate something, right? So, when you're risk tolerant, you're willing to accept risk. Okay. The longer your time horizon is, typically the more ability you're willing to accept risk because as things move over a long period of time, you have time to we'll say recover from when when markets are declining. If you have a very short term, right? So let's say you need money in 6 months. Well, you don't have a lot of time if the markets really start to decline pretty significantly. 6 months may not give you enough time to recover what you need to be able to pay off or pay for whatever you need in that for 6 months. So therefore, because your time horizon is shorter, you may need to be taking a less risky position, like putting money into a 6 month CD versus investing in stocks, for example. All right, loan rates. Well, remember, as I mentioned, right, loans are money that the institution has brought in through depositors, and they're paying the depositors a small amount of money. They're going to loan that money out at a higher interest rate, and then they are then going to keep the difference, right? So as that interest rate comes in, let's say they get 5% off of every dollar. So we have 5 cents coming in, but they're paying out 1 cent, right? So they get to keep 4 cents on every dollar in deposit. And that is where they make profit. Okay. So that is how they generate revenue so that they can maintain their operations and pay their employees and have their buildings. But that's where their profit generation is the spread between those two rates, what they pay and then what they actually charge on those loans. Here's another slide again on monetary and fiscal policy. This is actually something that is not specifically related to the banking institutions, but this is how the Fed can control interest rates. Okay. And we're going to look a little bit about that. So, monetary policy are going to be things that the Federal Reserve can do to control the money supply. Okay. And there's typically two things that they can do. They can do one, buy and sell in the open market operations. Okay. Now, we'll talk a little bit more about that. And then two, they can actually control the rate that banks will charge each other for overnight borrowing. And again, without getting into great detail, banks are required to maintain a specific amount of deposits based on their loans. So as that money changes, if they need more money because they have had more loans in order to make sure that they are adequately supplied with capital, they will borrow money. And as that interest rate gets higher for them, they're going to charge a higher rate for their borrowed funds because it's going to cost them more. Well, if it's costing them more and their interest rate goes up, more and more people will choose not to borrow money because rates are higher. So you can see that banks charging each other an overage of or a higher rate will actually cause fewer borrowing to occur. Okay, so what is the open market operations? This was the goal number one. So let's say they want to lower interest rates. Okay, so what can they do? The Fed can buy, and what is happening when the Fed buys? Well, the Fed is sending money to the financial institutions, and the financial institutions are buying a they're the Fed is buying something, right? They are buying their treasuries. So money is going to the bank, and the Fed is receiving this certificate. Okay, so the Fed is giving money out into the market. Well, now these banks have a bunch of cash. Well, what can they do with that cash? As supply increases, what happens to price of anything, right? If you're going back to your high school economics or your basic economics class, as supply increases, what happens to the cost or the value of that? It goes down. So as the Federal Reserve begins to flood the market with capital, or banks with capital, banks now have all this money, they want to loan it out. Everyone has more capital, so now they need to drop the rates, right? They need to make themselves competitive. Okay, so that will drive interest rates down. If they're trying to raise interest rates, they will just do the opposite. They will sell the treasuries to the banks, and in receipt of that, the banks will pay money. So the banks are buying something, right? So now that the banks don't have as much money in their wallet, now they have less money to lend out. So because they have less money, supply has shrunk. That means the value of that commodity, the cash, the money is going up, and that's going to cause interest rates to go up because I don't have as much, so it's going to cost you a little bit more. Okay, so when Fed is trying to lower interest rates, they want to buy, right? So remember, they want to buy. They want the money going out to the banks. So they're buying something. When you buy a car, money goes to you. You get the car, right? Money goes to the dealership. You get the car. So money's going to the banks. The Fed is getting the certificates, right? Those treasuries. When they want to raise interest rates, the Fed will sell, and that is where the treasuries go to the bank, and the bank in return sends money to the treasury for that. All right, well, that wraps up. I know it's kind of a little bit long. I tried to make things hopefully simple and provide you a little bit more context, but just wanted to give you some more insight on this idea of banking and financial institutions. Again, as we go through this class, as you have questions, please reach out to me and let me know. I'd be happy to answer those very quickly. With that, I will see you in the next video.